You ever wonder which retirement strategy actually leaves you with more money, the Roth or the pre-tax 401k? On paper, it sounds simple. Pay taxes now or pay them later. But when you run the math, the story changes. So today, I'm breaking down a real-world example. Two 35-year-olds, both investing $70,000 a year for 10 years. One uses a Roth, the other uses a pre-tax 401k. We'll see who comes out ahead at 65 after taxes, and I promise the results might surprise you. If you find this kind of breakdown helpful, hit the like button. It helps push this video out to more people who need real financial clarity. Now let's meet our two test cases. Roth Ryan and traditional Taylor. Both are 35, both invest the same amount. Both earn the same 6%. The only difference, Ryan pays taxes up front. His $70,000 becomes $49,000 after paying 30% in taxes, and then it goes into the Roth. Taylor defers taxes. He invests the full $70,000 pre-tax, no taxes due today. After 10 years, both stop contributing and they let the money grow untouched until age 65. Now let's see how this plays out. After 10 years of savings, Ryan's Roth grows to around $860,000. Taylor's pre-tax grows faster early, about $978,000, because his contributions were bigger up front. So at this point, most people would say pre-tax wins, hands down. But that's where most people stop thinking, and that's where the real difference begins. Let's look at the 20-year growth window. Both accounts now grow untouched for another 20 years from age 45 to 65, earning the same 6%. Roth Ryan's balance grows from $860,000 to about $2.93 million, and that's all tax-free. Traditional Taylor's grows from $978,000 to about $3.35 million. But remember, every single dollar is taxable later. And that's where the trap gets triggered. At retirement, Uncle Sam steps back in for his cut. So let's look at the retirement payoff. At age 65, Taylor's pre-tax balance is $3.35 million, but after paying his 30% tax bill, he keeps $2.35 million. Ryan's Roth is $2.93 million, and since it's tax-free, he keeps every single dollar. That's a $588,000 difference, even though they invested the same amount for the same time at the very same rate. And here's the kicker. Taylor's total tax bill ends up being over $1 million in the future taxes, while Ryan's locked in his rate decades earlier. This isn't about saying the Roth is always better. It's about control. Roth equals pay tax on the seed, harvest tax-free, where traditional equals save tax on the seed, harvest fully taxable. If you think your tax rates will be higher later or you want flexibility in retirement, Roth wins every time. If you're in a higher income year and expect lower tax rates, pre-tax might make sense. But here's the truth. Most people don't plan withdrawals strategically. They see their retirement balance and think, that's my money. It's not. It's a joint account with the IRS, and their share changes every time tax laws do. So here's the smart move. The best strategy isn't either or. It's blending both, Roth and pre-tax, to give yourself options later. And here's how the pros play the game. Build both Roth and traditional buckets. In high income years, lean pre-tax for the tax deductions. In lower income years, lean Roth for that tax-free growth. Convert strategically when your bracket dips. That's how you cut your lifetime tax bill and not just your next one. Now let me give you the real world side of things. In 28 years, I've never seen someone cash out 100% of their Roth. And although I use this example sometimes, I'm not advocating you do so. It's just to give us a start and a finish point to do comparisons. But I've never seen anyone fully withdraw and empty out a Roth. But I've seen plenty of people empty out their 401k or their IRA. They pay the penalties and they pay the taxes to start a business, to buy a house overseas, or to dig themselves out of debt. That's real life. In retirement, you're not taking it all at once. You're taking it strategically, year by year, to manage your tax game. But here's what I see again and again. The problem isn't not having money. It's that it's all trapped in pre-tax accounts. Every single withdrawal means Uncle Sam gets paid. And I've had clients with millions who didn't even need the money, but the IRS forces them to take it out through required minimum distributions. That's extra income triggered more taxes, higher Social Security taxation, and IRMA penalties that jacks up their Medicare costs. When you're young, it's hard to imagine these high quality problems. But I can tell you, I was the young guy stacking pre-tax money, thinking I was doing everything right. Then I realized the goal isn't to build wealth, it's to build choices. And that's the point of the videos like this, not to make Roth the hero, but to help you have options when it matters most. So I hope one day you're sitting with your advisor, high-fiving each other over the monster Roth you built, and you remember that some crazy guy on YouTube kept pounding the table about it until it finally stuck. Because truthfully, I don't see many million-dollar Roths, even among very wealthy families. But here's the real question. How much do you actually need to pay yourself to save $30,000 for retirement without overpaying in taxes? Because here's the shocker. Some plans are going to require you to take a six-figure paycheck in order for you to hit that same $30,000 target on just a fraction of the income. So let's break down exactly how each one works using the new 2025 rules. A client of mine, let's call her Jen, runs a boutique marketing agency. Her goal this year, save $30,000 for retirement without maxing out her payroll. Her CPA quickly said, just do a SEP IRA. But Jen hesitated because that advice didn't quite sit well with her and didn't make sense. And she was right to pause. Each plan, the SEP, the Simple, the Solo 401k, has very different contribution rules and income requirements. So I pulled the 2025 limits, I did the math, I did a side-by-side comparison, and what we found shocked her. I'm going to walk you through the same breakdown that we did right now. And if you like clear breakdowns like this, hit the like button. It tells me to make more videos and also helps reach more business owners like yourself. So let's look at the 2025 comparisons. First up is the SEP IRA. The SEP IRA, it's an employer-only plan, meaning all the contributions comes from the business, not from you as the employee. You can contribute up to 25% of your W-2 wages, capped at $70,000 for 2025 if you're under 50. So to put away $30,000, you need to pay yourself $120,000 in W-2 income, because 25% of $120,000 is $30K. If you're sole proprietor, that number climbs to $150,000 in net income after your self-employment tax adjustments. Here's the bottom line. It's simple to set up and it's easy to maintain, but it requires a high paycheck to hit that $30,000 mark. Also, it's important to note in the SEP, there's no Roth options and you cannot do catch-up contributions if you're over 50 years of age. And by the way, for those of you who don't know me, I'm John. I've been helping business owners simplify their finances and their retirement strategies for over 28 years now. So if you need help or you have any questions about how this applies to your business, I'm here to help. Just reach out. Let's move on to Simple IRAs. The Simple IRA is a setup for small teams, but has tighter limits. You can defer $16,000 as an employee plus $3,500 catch-up if you're over 50. Your employer match 3% of your salary. And here's the problem. If you're under 50, the most you can put is roughly $16,000 plus your 3% match. You'll never reach that $30,000 number with a Simple. And if you're over 50, even with that $3,500 catch-up, you need more than $350,000 of salary to stretch that 3% match high enough. The bottom line, it's a great starter plan for small teams, but not designed for business owners aiming to put $30,000 per year away. Now let's talk about the Solo 401k. The Solo 401k is where flexibility really kicks in, especially for self-employed owners with no full-time employees. You get to wear two hats here, the employee and the employer. As the employee, you can defer $23,500 plus $7,500 as a catch-up if you're over 50. As the employer, you can add 25% of your W-2 wages or 20% of your net profit if you're a sole proprietor. That brings the total potential to $70,000 if you're under 50 and $77,500 if you're over 50. So how much do you actually need to pay yourself to save $30,000 in the solo 401k? So if you're under 50, you can defer $23,500 and add about $6,500 from the employer side. That means you only need to pay yourself around $30,000 of wages to reach that $30,000 goal. Now, if you're over 50, you can contribute the $23,500 plus the catch-up of $7,500, taking you to $31,000, so you can hit your target with just $31,000 in income. Bottom line, more setup steps, but it's by far the most powerful tool, high savings at lower income levels, and offers both Roth and pre-tax options. So which one's right for you? Here's the big takeaway. Jen, remember Jen, almost went with the SEP, which would have required $120,000 in wages just to save $30,000. Instead, with the solo 401k, she hit the same target, only taking about $30,000 in salary. That's the power of knowing the math. The right plan is going to depend on your age, your business structure, and whether you want Roth flexibility or tax deductions now. The reality is most business owners, they're either overpaying taxes or they're underfunding retirement, simply because no one ever lays it out side by side like this. If you're wondering which plan fits your situation or how much you should pay yourself to hit your savings goals, let's talk. We'll spend 15-20 minutes, walk through your numbers, no pressure, just clarity. Thanks for watching, and if this is helpful, hit the like button or subscribe for weekly business wealth breakdowns such as this. Enjoy your week, and I'll see you next time.